Dr. Jared Ragusett is an associate professor of economics at Central Connecticut State University. He teaches and publishes in the areas of political economy, capitalist systems, stratification economics, and urban economics. His latest book is Understanding the Great Recession, a pluralist approach to U.S. capitalism in the 21st century.
Thank you. Thanks, everybody. Just to give you a little bit of background on myself, I'm an associate professor here in the economics department at CCSU. I have taught here since 2010. I was originally hired with my colleague Paramita as an emergency appointment, and I've kind of worked myself through. And as Gil said, I'm now department chair, and fingers crossed will be approved for full professor this cycle. I received my PhD from the University of Massachusetts Amherst, which kind of is an important backdrop to this work. UMass Amherst is one of the few heterodox programs, graduate programs in the field of economics, and that it integrates both orthodox and non-orthodox, very critical perspectives in economic theory and about contemporary capitalism. So that underlies part of the pluralist approach that is the subtitle of the book that I'll talk about as well. And my areas of expertise, in addition to all of this work, I publish and I teach in the areas of political economy and the history of economic thought. I teach this course, of course, and I also teach a course in Marxian economics, in addition to our standard micro and macro theory courses. But this book is the primary textbook now, or I've been sort of working towards building it as the primary textbook for my course on the Great Recession, which is Econ 408 in our course catalog. And this book really, as an economics textbook, does what most econ textbooks do, but in, I think, a very different way. It's not just a story of how this crisis unfolded and what was done to address it and some of the enduring legacy of the crisis, but it uses it as a case study in all different moments and in all different aspects of both the lead up to the crisis and the policy responses and what's been done since then. It uses the crisis as a case study for understanding economic concepts and principles, which we do in any other economic course. We use it to understand economic behavior because there's all types of aspects of the crisis in terms of household behavior or the behavior of firms or the behavior of government that, again, we cover in our econ courses, but is presented in this very fundamental way during this crisis. It's also used to examine the conduct of economic policy making, which again we talk about a lot in especially our intro macro courses, but was deployed in very significant ways during and after the recession. And as I said, it's also used to introduce students to competing schools of economic thought. I'm very careful throughout the book of introducing different perspectives from both conventional perspectives in economics, but also critical perspectives about this crisis. So I thought I would talk first about how this all came to be, because I kind of fell into this work progressively over the years, and if you were to ask me back in 2004, 2005 that I'd been sort of an expert in this area, I would have been very surprised. And so it was this kind of gradual process. So in the summer of 2006, I was working on my doctoral dissertation, and my dissertation actually focused a lot in the area of urban economics. And what I was doing was critiquing a body of work in conventional economic theory about the relationship between metropolitan land use patterns, different patterns of urban sprawl, and how it affected racial inequalities in the housing market, in terms of housing consumption, in terms of mortgage lending, as well as residential segregation patterns. So that was really kind of where I was going towards. I was much more focused on urban economics, but with this heterodox perspective. And during that summer, I was also teaching a money and banking course during the summer. And towards the end of that session, in fact, it was the very last week, is when you started to hear some of the rumblings about financial distress. Housing prices were starting to come down after this very market appreciation in the early 2000s, and you started seeing these articles in the New York Times about investment banks having trouble and these mortgage products called subprime mortgages. So this was all like very, very new. This was, I think, early August. And I remember the last day of class was just pulling together some articles and talking about like what are these mortgages and what's sort of going on and where this might be headed. Not knowing, of course, the calamity that was going to ensue. But I quickly realized that this is all sort of tied into my dissertation, that a lot of the outcomes that I was analyzing in my dissertation were fundamentally related to the changes in access to credit, which did affect historically underrepresented groups and new homeowners in very, very fundamental ways. And then that led to exploring all of these complex issues of financial structure, about how the financial sector and commercial banks and investment banks and the credit ratings were spinning off all these securities and the insurance contracts that eventually were building towards the crisis. And so a few years later, at that time, I was working as an emergency appointment at another university in Western Massachusetts, and I lost that position in part because the university had invested a lot in some of the securities that went down, and so that's actually how I ended up here. So I was hired here in 2010 as an emergency appointment, and I think Paramita probably remembers in our initial letter from President Miller, there was this very bold statement at the bottom that should the economy tank again, we can't guarantee employment because things were very, very dicey and the state budget was dicey as well. But then at that point, by fall of 2010, things had changed. Even though the presumption was that the recession was still unfolding, there was the surprise announcement in September of 2010 that the economy had reached the bottom in June of 2009, which, like I said, was somewhat surprising. There was still a lot of uncertainty. All of the major policy responses had been enacted to that point. All the fiscal interventions, the tax cuts, the stimulus bills, the series of stimulus bills, all of the responses in terms of monetary policy, interest rates, quantitative easing, as well as Dodd-Frank and financial reform. But I was also intrigued by the fact that although the presumption was that the crisis was unfolding, I was surprised by the political backlash towards the stimulus measures. And so that was the very contentious fall 2010 election when the Tea Party comes into power and sort of comes to power on this anti-government sort of fiscal austerity movement, right? And I thought that was surprising because, and I talk about this in the book, during the Great Depression, there were all these major, reforms and restructuring and policy interventions. And certainly the government chipped away at those progressively over the years, but it took about until the 90s for the government to really sort of deregulate all of the financial interventions that were put in place during the Great Depression. But I was surprised by this crisis because the crisis wasn't really over yet, and already people were sort of ready to let loose again. So I thought that was very intriguing, and so. At that point, once I got the tenure track job, I started thinking about maybe offering a full course because I could draw upon my dissertation work in terms of all the mortgage lending and the stuff with financial structure, which is extremely important. You had three major sets of policies that you could certainly introduce students to, but then also explore these really important sort of political and social debates that were going on about the role of government and the size of the budget and all these sort of regulatory questions that were coming up in the early 2010s. So I finally offered that course in the spring of 2014, and at the time there was a reader that was published on the market that was very helpful, but it was published in 2009. So I was taking the readings from that book and then supplementing it with original resources, data, reports, think tank stuff from the Congressional Budget Office, because after 2009, things were fundamentally changing in terms of the political atmosphere about the responses to the crisis. So that was good in the sense that students were working with all these original works and direct sources, but it was hard to keep up, right? And what I realized was that the syllabus that I was putting together was kind of a chronological presentation of the crisis, and that's how this book is structured. And so I thought, well, maybe I should just put this all together and write my own book, because my syllabus looked like a chapter outline. So to think about this further, I put together a panel. I organized a panel at a conference for January of 2017, and I brought together some other people in my area of expertise who also taught in this area, or who also used the 2008 financial crisis and the Great Recession in their courses, just to talk about pedagogy and best practices, but also bounce some ideas about a book. And by coincidence, one of the associate editors at Rutledge was looking at the program, and the publishers do come to these conferences just to present and network, and sat me down and said, "Have you ever thought about writing a book?" And I said, "Yeah, actually I have." And so that's where this all sort of took off. So then we worked on a proposal, and then I wrote it after that. So when I talked to him about this book, and he was certainly very intrigued, he asked me some very challenging questions like, why does this crisis require a textbook? And that's a good question. I don't think there are any courses on the 2001 recession, right? Not that people didn't lose money or weren't negatively affected, but not every recession is the same in terms of its severity. Similarly, I don't think there's any courses on the 1990 recession, but there's something different about this one. And so this book and the course is significant in a number of ways. One, it takes the rare approach in the economics discipline of analyzing our economic system when it fails. That is something that most economists don't do. Most of the time, in most conventional theory courses, we teach about things like equilibrium, right? So how the economy can get pushed off or somehow comes back to balance. This is certainly something different. As I mentioned before, it also takes a pluralist approach in that it treats orthodox and radical theories in economics as equals, and sort of introduces readers to those frameworks through their investigations of the crisis. And then, like I said, it also presents the crisis in a chronological fashion, okay? And so what I do is I essentially start from the Great Depression of the 1930s. I start talking about that restructuring and what happened in U.S. capitalism throughout the late 20th century. I talk about the crisis itself and all the major policy responses, and most importantly, its enduring legacy. And this is what I try to really drive home to students, are all of the ways in which this crisis, even though we have, of course, recovered from it, still has enduring effects on our lives and our decision making. And that was another interesting question that he posed to me when I first met him at that conference in 2017, because at that time, the economy was still doing very well, and it had been quite a long time. It had been like over 8 years, I believe, at that point, since the economy had recovered. It was still historically a very strong recovery. And so his basic question was, well, what's going to be the end of the book? If you're going to take this chronological presentation, like how do you finish it up? And this is absolutely true. I jokingly told him in terms of like where my timeline was going to be for writing the book, I said, I actually hope the economy tanks in 2020, because by that point, I could say, well, if there's an actual trough again and the economy tanks, then I can at least say, well, once the next recession happens, that's the end of this story. And I was right, and I was on sabbatical in the spring of 2020, so I'm working at home, and then that's when it hit. So I hope I didn't manifest this, but that was kind of an interesting part of it. So I just wanted to talk quickly about, like I said, the chapter overview and how this book progresses through the crisis. So the first chapter is basically an introduction to both the timeline. It refreshes readers about all of the major events, starting with the peak in housing prices in 2006, and then moving through the financial crisis, the economic crisis, the policy responses, up until about, like I said, 2020. But it also presents some of the competing perspectives that are going to be used throughout the book. What is a traditional conventional perspective, and then also the diversity of perspectives that I draw upon from heterodox economics, institutionalist, Marxist, post-Keynesian, social economics, feminist economics as well, to name others. Then the next four chapters really focus on the lead up to the crisis, okay? Basically until the government starts intervening in very, very significant ways. The second chapter is essentially an economic history chapter. I use that chapter to introduce readers to what is called social structure of accumulation theory, which is a heterodox perspective about economic growth and development, long-term economic growth, and the evolution of capitalism. I start, like I said, with the Great Depression and the restructuring then, all of the post-war boom, until the crisis of the 1970s, the oil crises, the opening of global competition, all the deregulation that eventually comes in during the 80s. And then I walk readers through basically the 80s, the 90s, and the 2000s, right? The sort of hardcore conservative shift of the Reagan-Bush era, the Clinton era, but also all of the new instances of things like free trade, globalization, technological innovation, and then the Bush administration during the 2001-07 recovery, which was basically kind of a redux of Reagan. And then in the next chapter, I examine the housing market crash, looking at all different issues related to the measurement of home values, how in economics we understand the presence of a bubble or a market crash. I also get into the complex issue of redlining in order for students to understand the disproportionate effects on historically underrepresented groups in the subprime market. If you want to understand the presence of what's called reverse redlining, you first have to understand classical redlining, as well as some of the major foreclosure responses by both the Bush and the Obama administration. Then the next chapter puts the whole house of cards together with regard to financial structure, how you then go from mortgage lending to mortgage-backed securities, so the role of private investment banks, Fannie Mae and Freddie Mac, the role of the credit ratings agencies, the role of the insurance companies and credit default swaps, and how this is all built up in order to understand how it all falls apart once housing prices begin to correct. I also present to students how all this was transmitted to the real sector in terms of the recession, the collapse in economic growth and investment and consumption. And then I also go through the bailouts, the funding of the bailouts, the different sort of piecemeal responses until you get that Emergency Economic Stabilization Act with purchasing toxic assets, all the capital injections, and then opening up FDIC insurance. And then the last chapter in that series presents all these different competing explanations. So I kind of go from left to right throughout the field of economics about how different major thinkers have explained this crisis, starting with Robert Lucas, who tends to be more on the conservative end, Alan Greenspan's famous testimony before the House of Representatives in the fall of 2008, as well as some radical perspectives, a Marxian perspective, a post-Keynesian perspective, even a feminist perspective on the transmission of the crisis. Then the next three chapters examine all of the policy responses. So each chapter respectively goes through a set of responses by the government, the first of which is Dodd-Frank. And what I do in that chapter is I basically take the financial structure that I established in Chapter 4 and explain all the ways in which Dodd-Frank addresses that or tries to put a plug in it. Then I turn to monetary policy. I think this chapter is probably the one that I'm most proud of because what it does is it explains how the conduct of monetary policy itself has changed as a result of what the Federal Reserve did during the early 2000s. Because they pumped so much money into the financial sector through quantitative easing, the tools of monetary policy itself have changed. So I start with the ones that you'll see in a typical macro textbook, like reserve requirements, the discount rate, and open market operations, and how that evolved with the responses during Ben Bernanke's period, and then later Janet Yellen. And then the last chapter in that series is about fiscal policy, all the major tax cuts, stimulus packages by both the Bush administration, the Obama administration, and then some of the smaller packages that were passed during the early 2010s. Okay. And then lastly, the final chapter focuses on the recovery, not just in terms of the data analysis and some of the policies that are passed during the recovery itself, but I focus a lot on the upsurge in inequality and the political divisions that have really, come to attention, especially since the 2016 election. I focus a lot on sort of this steady wave of populism on both the left and the right as it relates to some of the responses from the responses to the financial crisis. Even starting during the 2008 election with Sarah Palin's candidacy as vice president, which eventually leads to the Tea Party wave. You have a Republican loss in 2012, but then that sort of builds into Trump's campaign and the House Freedom Caucus, and how a lot of Trump's campaign, of course, was a direct response to some of the interventions that were passed by both Bush and Obama during this period, right? And also indirectly, right, because once the Tea Party comes in 2010 and then later 2015, they didn't wanted nothing to do with Obama's economic agenda, so Obama pivots to DACA, the Iran nuclear deal, the Paris Climate Accord, which only adds more fodder to some of this right-wing rhetoric about, American sovereignty and things like. So there is kind of a lineage there. But I also trace some of the left-wing populism as well, that the Democrats became more progressive because a lot of them, I think, feel now that, the bankers kind of got away with it. And so that's why I think you're seeing these serious proposals for Medicare for all, more attention to racial and gender stratification, student loan forgiveness, Bernie's candidacy twice as a Democratic socialist, and some of these other sort of, young populist persons of color that have been elected to the House and the Senate during this time. So yeah, that's where I end up. And like I said, I end it with essentially the onset of COVID, because once the next recession hits, that can be another book in and of itself, right? So I felt that was a good place to stop. So with that, I'm happy to take any questions.
Questions?
David, yeah?
Sure. You referred to the banking aspect, and one of the observations that I was making at the time, and disclosure, I did work for J.P. Morgan.
Yeah.
But as these institutions like Bear Stearns Washington Mutual bit the dust, J.P. Morgan was the go-to rescuer to take these institutions on with full approval of the Fed to do that. So you had this process where strong, big banks got bigger and stronger, while you had this deterioration in the middle of the pack, basically. And I think a lot of that came about because you had almost a complete reversal of the blanking on the name now, the act, the separation of investment banking.
Oh, the repeal of Glass-Steagall.
Glass-Steagall.
Yeah, of course. Yeah.
So there's a kind of a merry-go-round.
Yeah, I agree.
Ferris wheel effect there. And I wonder what your take is right now on the state of the banking industry right now.
Yeah, and actually, I went to a conference last week, and I was presenting a totally different paper with one of my coworkers, and we got into a discussion about that. And I do talk about this in the book in terms of some of these supervisory rules that were imposed by Dodd-Frank, originally in Dodd-Frank, about these resolution plans, these annual stress tests that the banks of certain size have to demonstrate that, well, if you're hit with these certain market conditions, do you have enough capital to manage this? And then that was eventually, well, it wasn't repealed. There was a partial repeal of Dodd-Frank in 2018. And so that rule is still in place, but they've changed the threshold of what's going to trigger those types of interventions, right? So in the original text of Dodd-Frank, it's fairly low. It's like $50 billion, and they bumped it up to like 250. And there's certain ranges where they don't look at you, or they might look at you, and then you're required. And some have argued that played a part, in part, to what happened with the Silicon Valley banks last year, because they weren't required to undergo those stress tests, and may have fallen into that previous threshold that was part of the original law.
And now you have the likes of Jamie Dimon, J.P. Morgan, arguing strenuously against the Basel III capital requirements that are proposed.
Yeah. Which isn't surprising, but yeah. Oh, Grill, yeah.
Both sides, as you said, both, kind of the political spectrum kind of reacted to the bailouts and to the recession just in general. And of course, everybody wants bad guys, right?
Yeah.
Were there bad guys? And if so, I mean, we want to blame people, right? Is it just too simplistic to say they're the bad guys, they're to blame, whoever they are?
I mean, there was certainly control fraud, right? And there were major lawsuits, and there were major settlements against mortgage lenders, because in many cases they were cooking the books, right? And so there were major settlements. There was a big one, I think, in 2012. Bank of America was involved in, and like all these major lenders. But the not to let anyone off the hook, but the perspective that I take is that this was part of a long process of restructuring, right? That you had this very regulated, government-led kind of brand of capitalism after World War II. That runs into problems during the 1970s, and that's in part why you get this more sort of conservative, deregulated, free market mindset that comes into place in the 80s. And so just as there was, back in the post-war area, somewhat of a, I won't say a consensus, but you had, presidents from both parties that's kind of involved in that restructuring, right? It wasn't just FDR, but it was also Dwight Eisenhower. Dwight Eisenhower signed the Bank Holding Company Act, which separated insurance from commercial banking and between banks and other non-bank firms. The same thing sort of happened after the 1980s, that there's this conservative pitch that Bill Clinton as well bought into during the 90s. Because he was the one that signed the deregulation that deregulated interstate banking, as well as the separation between insurance, commercial banking, and investment banking. So everyone sort of had a part in that, I think, that was very, very, very important, right? And then now, like, everyone's mad, right? So,
what would have happened if there wasn't the bailout? If there weren't the bailout?
That's a great question. So in the fiscal policy chapter, at the very end of all the policy responses, I go into a lot of detail about two really important studies by economists Alan Blinder and Mark Zandi, and they measured this, right? They basically took the macro model that's used by Moody's, which is the rating agency, and they essentially plugged in all these different econometric scenarios about what would have happened had you not had, to put it broadly, the fiscal responses, the financial responses, or both, right? In terms of how long would the recession have lasted, how long would unemployment have peaked, what would have happened with inflation and with job growth. And what they find is that the fiscal policies were very, very important and certainly saved a lot of damages to economic growth, unemployment, employment, and inflation. But the financial policies were more significant in terms of shortening when the actual trough came about in June of 2009. So, I mean, no one can know for sure. And they also do, and if you go to their, I don't do this in the book, but in their original papers, they even look at some more specific interventions like the auto bailouts or some of the specific monetary interventions. But in the worst case scenario, had the government done nothing, right? Just, no extension of unemployment insurance, no major monetary policy interventions, that the recession would have lasted well into 2011, and you would have had double-digit rates of unemployment throughout the early 2010s. So, and again, it's a holistic perspective, right? Because certain more specific policies, there's a lot of scrutiny and debate. But that's what they find. And I do have some nice graphs too about when those points would come about. Oh, go ahead, Dan.
Thanks. I just wanted to ask about, it's a very wide-ranging book, you cover a lot of territory focused on this one event.
Yeah.
Do you touch on the global impact of the recession at all, or is it mainly focused on the U.S.?
That's a good question. In the original draft, I did want to have at least a chapter on some of the global implications. But both I and the publisher agreed it was probably just going to be too loaded, and because then you could get into Greece, Iceland, Ireland, all the EU, Brazil eventually in 2014. That would almost be a book itself. And they actually, one of my friends from grad school did write a book that's similar to that. But I do, throughout the book, I get into some of the global issues, and that became a major point of debate. In fact, Alan Greenspan argues that, oh no, it wasn't financial restructuring or financial deregulation, it was all this global demand for mortgage-backed securities. So, I mean, these poor capitalists in Wall Street just couldn't help themselves but create all this stuff because they had all this influx of demand from the rest of the world. So it is integrated into it, but not necessarily in a standalone chapter. But yeah.
This is a follow-up question. I mean, what is the role of economic globalization in how this sort of crisis was different from previous crises or potential future crises?
Yeah, and I talk about that too, and some of the restructuring throughout the 70s and the 80s, right? As globalization became the thing in the 80s and 90s, the global financial architecture really had to be reformed, right? Because of the increase in global competition, especially when some of the major countries involved in World War II had recovered by the late 60s and 70s, that became very important, right? And that's in part why a lot of those deregulations happened during the 80s and 90s, because in order to facilitate more global competition and more exchange globally, you needed to have a more liquid global financial architecture, which in part laid the foundation for some of the practices that I talk about.
Just kind of a general question, how does cryptocurrency figure into all of this?
I don't get into it too much, at least in this book. My colleague here is the expert, but I think there is a connection in part. There's always been criticism, distrust at times of the Federal Reserve, and so I think in part there is a connection to this movement through virtual currencies that is related to this. On a more practical level, this is another example of why it makes the conduct of monetary policy so much harder, right? Because there's all these outcomes and activity that just don't fall into the traditional banking system and the monetary system. So that's another thing that I had to sort of cut it somewhere, because I think that would have led it in a different direction. But yeah, I do think there are some important connections to that in terms of some of the responses that we've seen, just because of how so much capital they pushed into the financial sector, and it's still there. Yeah.
Well, thank you very much, Jerry.
All right, thanks so much. Appreciate it.